Running a small business is no easy task. With so many moving parts, it's crucial to keep a close eye on your finances. Yet many small business owners find financial statements confusing or overwhelming. But what if I told you that mastering these documents could be the key to your business's success? In this video, we're going to break down financial statements, explain why they matter, and show you how to use them to make smart decisions that can drive your business forward. What are financial statements? Financial statements are the pulse of your business. They provide insights into your company's financial health, performance, and growth potential. Essentially, these documents give you a clear picture of what's going on behind the scenes financially, allowing you to make informed decisions. The three most important financial statements every small business owner should understand are 1. The income statement, also called the profit and loss statement. 2. The balance sheet. 3. The cash flow statement. Let's explore each one in detail. The income statement. The income statement shows your company's revenues and expenses over a specific period of time, such as a month, quarter, or year. It's used to assess whether your business is profitable and helps identify areas where you might need to cut costs or boost sales. How to read an income statement. Revenue. This represents the total amount of money your business earns from selling goods or services. Cost of goods sold, COGS. The direct costs involved in producing your goods or services. Gross profit. Calculated as revenue, COGS. This is the profit made before deducting operating expenses. Operating expenses. These include rent, utilities, marketing, and salaries. Expenses not directly related to production. Net profit. The bottom line, or the remaining profit after all expenses, taxes, and interest are deducted from gross profit. Example. Imagine your business made $200,000 in sales this quarter, with $120,000 in production costs. Your gross profit would be $80,000. After accounting for $40,000 in operating expenses, your net profit would be $40,000. Why it matters. The income statement is critical because it shows whether your business is profitable. A positive net profit means your business is generating more money than it spends, while a negative net profit is a red flag that expenses are outweighing income. The balance sheet. The balance sheet provides a snapshot of your business's financial position at a specific point in time. It lists your company's assets, liabilities, and equity, showing what your business owns and owes. How to read a balance sheet. Assets, what your business owns. This includes current assets like cash, inventory, and accounts receivable, as well as fixed assets like property and equipment. Liabilities, what your business owes. This includes current liabilities like accounts payable and short-term debt, as well as long-term liabilities like loans. Equity, the value of the business that belongs to the owners, calculated as assets, liabilities. Formula, assets equal sign, liabilities plus equity. For example, if your business has $500,000 in assets and $300,000 in liabilities, your equity would be $200,000. Why it matters. The balance sheet is essential for assessing your company's financial stability. It shows whether your business has enough assets to cover its liabilities, which is crucial for evaluating your business's risk and long-term viability. A strong balance sheet with more assets than liabilities indicates a healthy business. The cash flow statement. The cash flow statement tracks the flow of cash in and out of your business. This statement is particularly important for understanding your business's liquidity, whether you have enough cash to cover day-to-day operations and invest in growth. The cash flow statement is divided into three sections. 1. Operating activities, cash generated from core business activities. 2. Investing activities, cash used or earned from buying or selling assets, like equipment. 3. Financing activities, cash flows related to loans, debt repayment, and issuing equity. Example, if your business had $50,000 net cash inflow from operating activities, spent $20,000 on investing in new equipment, and used $10,000 to repay debt, your total net increase in cash for the period would be $20,000. Why it matters. The cash flow statement reveals whether your business is generating enough cash to sustain operations. Positive cash flow is essential for growth, and understanding this statement helps you plan for the future, whether that's expanding your business, paying off debt, or investing in new opportunities. Making smart business decisions with financial statements. Once you understand how to read financial statements, you can use them to make informed business decisions. Here's how. 1. Analyze trends. Look at financial statements over multiple periods to identify trends. Are your revenues growing, or are expenses rising faster than sales? This analysis helps you make proactive decisions, such as reducing costs or scaling up production. 2. Use ratios. Financial ratios provide insights into efficiency, profitability, and risk. For example, current ratio, current assets, current liabilities. A ratio above 1 indicates good liquidity. Gross profit margin, gross profit/revenue. A higher margin suggests better profitability. O, debt to equity ratio, total liabilities, shareholders' equity. A lower ratio means less risk. 3. Budgeting and forecasting. Use your financial statements to create budgets and forecasts. This helps plan for future expenses, set revenue targets, and guide decisions like hiring or expansion. 4. Seeking financing. Investors and lenders will scrutinize your financial statements. A solid understanding of these documents shows potential investors that your business is financially sound, making you a more attractive candidate for loans or investments. Common mistakes to avoid. Even experienced business owners make mistakes when it comes to managing their finances. Here are a few common pitfalls. Ignoring financial statements. Failing to regularly review your financial statements can result in missed opportunities or signs of trouble. Confusing profit with cash flow. Remember, just because you're profitable doesn't mean you have enough cash on hand to cover immediate expenses. Overlooking liabilities. Focusing only on your assets without considering liabilities can give a false sense of security. Not tracking expenses. Accurate expense tracking is crucial for generating correct financial statements. The importance of financial statements. Understanding and regularly reviewing your financial statements is critical to the success of your small business. These documents offer a window into your company's financial health and provide valuable insights for making smart decisions. Whether you're budgeting, seeking financing, or planning for growth, mastering your income statement, balance sheet, and cash flow statement is key. Take the time to review your financial statements regularly, and don't hesitate to consult a financial professional when needed. The better you understand your financial statements, the better equipped you'll be to make decisions that support your business's long-term success. What's your experience with financial statements? Have they helped you make better business decisions? Let us know in the comments. And if you found this video helpful, don't forget to like, share, and subscribe for more small business tips.